why is it important to have a mentor in this industry, specifically trading and portfolio management?
Yeah.
I guess that's the question.
Yeah, it's a very relevant question. It's no different to any other industry. You know, people for some reason think trading and portfolio management is different. I don't know why. It really is the same as any other industry. You need the older guys in the industry to give you guidance in your career and show you what's what. You know, for guys who have been there, done it, bought the t-shirt, been around the block several times. And I think it comes really down to two things with mentors, specifically in trading and portfolio management. It's, first of all, when you're young, really understanding how the industry operates, how the industry works, knowing the ins and outs of the industry. And secondly, guidance in the details of how to actually become a successful trader. And one of the first things that you really have to understand, not about the industry, but how to become a successful trader over time, is how you deal with and how you lock out or eliminate, if you like, emotion in your trading. And that was really important for me. When I was a young trader, it took a long time, you know, to really become a trader that's, I guess, unemotional about positions, portfolios, the financial markets. Because the market really doesn't care about you as an individual, and money doesn't care. The stock doesn't care that you're buying or shorting. Any asset class that you're in, money is unemotional, and you have to be unemotional about your trading decisions and your P&L. You have to have, how do you put it, like emotional detachment. If you have emotional detachment to your P&L, then you can actually have consistency when you make losses and when you actually win. So when your P&L is down, when your P&L is up throughout your career. And consistency is really, really important. And this is why people get emotional in trading, because they can't handle that stuff. They can't handle losing money. They can't handle making it. And it's different emotions, but they're still emotions. And what you've got to remember is in financial markets, and this is really key, like you really have to accept this in trading. When you buy something, you pay the offer. And when you sell something short, you sell on the bid. And your P&L, when you buy, is marked on the bid. And your P&L, when you sell short, is marked on the offer.
So you're losing money by default.
Yeah, exactly. So essentially, the moment you press the button when you trade, you are losing. And losses are just a part of the game. And you just have to accept that. And most people just can't accept it. Now, for me, I picked it up quite quickly because I had some seriously good mentors when I was young. Obviously, I was at Goldman Sachs. And the guy that really taught me this was Christopher Cathy.
Right.
So I was 21 years old when I walked into Goldman Sachs. And Chris was one of my mentors. And he really, really nailed it into me, how to eliminate your emotions from trading and how to get emotional detachment from your P&L. And obviously Chris is going to be here. Mm-hmm. So you should actually ask him that question. Pull him to one side and ask him that question.
Sure.
And see what he says about emotions and how you eliminate emotions from trading.
Best.
Okay.
Yeah, so we were just talking about how professional traders and retail traders are kind of in the same boat. Now, there's been a lot of access to information for everybody. And in fact, professional traders are really at a disadvantage because they have this big processes, they need to go through. They usually have to move a lot more size. So as a small retail trader, you can really do well, but you need to have the right educational exposure. You need to have a coach or get training somehow, because you can't just go out there and expect to make money because you read some book, because some expert wrote something in the book. But yeah, I mean, it was mostly about how the investment environment, I think, has changed a lot. Back in the day when I started in the 90s, it was the benefit was much more to the professional investor, because there wasn't an internet back then, and as a retail investor, you had really didn't have many opportunities to get access to information. So you were at a huge disadvantage. But now you really, I think you come to a point where you come to like a crossroad where the advantage is actually leaning towards the retail trader now. But with that also comes, added potential for risk. So you need to understand what you're doing. Otherwise, you can really lose money just as fast.
How's it going, Chris?
Yeah, it's great. Just off now to have dinner and drinks with the mentors. Yeah, looking forward to it. It's been busy, as always is with Anton. And yeah, looking forward to a good night.
So speaking of mentors,
Yep.
I spoke to Anton the other day about the idea of mentors and the idea of needing a mentor to help with this idea of removing emotion from trading and the importance of remaining emotionless in trading. And he said to speak to you because he said that you were his mentor at Goldman Sachs.
That's right, yeah.
And you helped him
Yep.
very early on with understanding the importance of emotions in trading, or rather the lack thereof.
Absolutely.
So why is it so important?
It's absolutely essential. And with Anton, I first met Anton in, I think it was 2000 when he joined Goldman Sachs. He was there for about 4 or 5 years, of which 2 years he was part of my team. Most of the time he was sitting next to me. And so he was learning from his very, very early learning stage, was sitting next to me and learning, hopefully, from the benefit of my experience. Controlling emotions is absolutely essential to being a successful trader. You need to be able to increase and decrease risk appropriately. You need to make the right decision at the right time and be able to perform the right action, the correct action. That only happens if you're objective. If you allow your emotions to come into trading, you will end up trading unprofitably, because the natural human nature is to take profits too quickly and to cut losers too late. At the Institute, we teach the benefits of our experience, that we teach you that you need to cut losers quickly and let profits run, which is counterintuitive to human nature. To learn how to control your emotions and be objective at all times only occurs through a process of either trading your own money or trading somebody else's money. You cannot learn this by paper trading. You need to have some skin in the game. And by doing that, you will have the emotions which want you to, when you're losing money or making money, you tend to over-exaggerate. So you'd be too low when you're losing money, too high when you're making money. We need to control that. You only have that roller coaster when you have actually money invested.
So it's safe to say that there's only so much of trading that is academic?
Absolutely.
Yeah.
There are definitely academic parts to trading. Clearly, the idea generation. The idea generation is coming up with ideas for trades and the reasons you need to justify to yourself why you like certain trades or what's your rationale for having certain trades on. That is 50% of trading. The other 50% is risk management. So the risk management is to ensure that you get the best returns from your trades that is possible, which means maximizing your winners and cutting the losing trades. Either getting stopped out. If you get stopped out, you have to remain emotionless, be objective. You hit your target, your stop loss. You hit your stop loss. Exit the position. Cut it as quickly and as effectively as you can.
Can you think of a very quick, can you think of a practical example of this in your career?
Yeah, practical example, obviously I've been stopped out numerous occasions and I know the process that you have to go through, because anybody puts on a trade they have an idea behind it. So you, by getting stopped out, you are admitting to yourself that you are wrong. Maybe just in the short term, but you are wrong. And that is very, very difficult to learn. How to do that, once you've done it, that's where you take the emotion out of it, and you've lost the maximum amount of money that you want to lose in a trade. That's when you cut the position. That's your stop loss. Examples for myself where you need to be disciplined and maintain your objectivity. Good example, I was short some telecoms. I got short Deutsche Telekom a long time ago when I was trading at Goldman, and I knew the hedge funds who were buying it from me would be buying it in multiple places, taking the market higher. So rather than watch tick for tick and get squeezed out of the position, I just went for a walk for 10-15 minutes, came back, stock had moved 3% against me and came right back down again, and I maintained my objectivity. That's a lesson for myself.
Right, and it's important.
It's absolutely essential, absolutely essential.
It was an amazing evening. What we taught the guys today was how not to screw things up. And this is what we do at the Institute. The first step we always take is show guys how not to screw it up. Yeah. The second thing we do is show them how to actually make money. And how you actually make money is to get a really solid overall foundation in your education for trading. And that takes about 1 to 2 years. And you have to do it in 2 steps. You have to learn all the theory and you have to do it with real money. And this solid educational foundation is so important because it essentially gives you a base that you can always go back to. And what I mean by that is you become a more rounded trader, which means if your strategy in the future is not working, as in trading you're focusing on a specific area, if it's not working, you can default and move to something else. And you always have that foundation to go back to. It's really, really important stuff. Educational foundation is so important, and probably the best mentor to speak to about stuff like that is Jason McDonald, because he's been there, done it, seen it, hedge fund side, investment banking side.
It's a 2-step process, right?
Yeah, so you've got to learn how the landscape is, how the industry works, so you can always go to areas where money exists and you can follow the money. That's what trading's all about. You have to follow the money. If something's not working, you have to go somewhere else within the industry. And if you have a rigid trading strategy that doesn't work for whatever reason, at a moment in time in your career, if you have that foundation, you can go back to your basic skill sets, and then when you go back to your basic skill sets, you can follow other areas within the industry and follow the money and make money from where the opportunities exist. If you don't have that foundation, you don't even have that choice.
Thank you so much.
All right,
Nice
cool guys. Yeah. Take it easy, yeah?
Cheers.
Take care. Look after yourself.
So Anton, we've just spent the day in the city.
Yeah.
We revisited some old haunts today.
Yeah.
You're obviously looking back on it with the perspective of someone who has spent a lot of time in the city. As a young guy, how did you come into it and start and actually figure out the world of trading?
That's a good question, like figuring out the world of trading. Wow, okay. It took a long time. I started as a retail trader.
Right.
And I was trading with my own money as a teenager. And then went to university, carried on, and then was hired by Goldman Sachs. And I never really started genuinely figuring it out until I was actually in the city. Because there is an investment spectrum. And when a professional trader uses the phrase investment spectrum, what they're talking about is on one side, all the way over here, on one extreme, you have, for example, value investing. And then all the way on the other extreme, you have short-term trading. And in between you have many other things, many other strategies, many other time horizons. And trading these days has shifted from short-term trading to a time frame and an approach which is encompassing a lot of different strategies. And professional trading strategies now are like 1 to 3 months, unless you're quantitative, okay? Once you go over a certain time horizon, it stops becoming trading and it becomes investing, okay? Once you focus on the time horizon that still encompasses trading, there's many different strategies that you can deploy, okay? And yesterday we talked about, for example, when you asked me about the education of what traders would need, like joining the industry. The first step is always to get like a broader overall understanding and broader education, okay? The next step is actually finding that sweet spot within trading over those timeframes that are trading, not investing. Finding that sweet spot that suits your personality. And this is something we always push in the Institute. It's like you have to have a systematic process. You have to understand that you need a broader perspective. Not everybody is suited, for example, within the trading spectrum to short-term trading. Not everyone is suited to long-short portfolio management over a 1 to 3 month time frame. But if you get the discipline and the broader education first, you can always adapt and always be flexible if something's not working. You understand how a systematic process works, and then you can shift your systematic process over time to adapt to market conditions. And actually, like mentors that we have right now, because they've done so much in the past and so many different things within the trading remit. Guys like Tristan, for example, have been long-only managers. They've been long-short portfolio managers. They've been short-term traders on trading desks of hedge funds. And actually, a guy like Tristan would be amazing to speak to about this. And he actually gives a seminar in Australia, literally called Matching Personality to Process, where if your personality is more suited to things, you should be concentrating on that. But you shouldn't concentrate on it from the outset. Right. Retail traders jump in to short-term trading typically because they think that this is what they have to do. Or they jump into stuff that think their personality is matched to from the beginning. And they don't realize that when they start doing things, either it doesn't pay, as in it doesn't work, or their personality is not suited to it, and they have to then continue finding what actually works for them. And it's all about hitting that sweet spot. Now, the Institute's education, for example, gives you that broad education. And then within that systematic process, you can actually go out and find where your personality is best suited within the process. So it's very, very flexible. And if you speak to Tristan about it, he'll give you some really good tips on how this works. So if you get 5 minutes with him at any time during the week, definitely speak to him about it. He's flown in to be a guest speaker. He's going to be talking about the hedge fund process. He's the expert. He's one of the top hedge fund managers on the planet. He's agreed to speak at the conference, flown in this week from New York, and I'm sure everybody's looking really forward to it.
We're one of the largest long-short equity funds around, certainly in the U.S. We can be anywhere between 5 to 7% of the daily trading volume of the New York Stock Exchange, so we're pretty active. I think the biggest takeaway for somebody who's a retail trader is to manage your risk. It's very hard to make money. Even the best traders are right only half the time, and it's really being careful to not lose as much as it is to win. So I would think that's the most important takeaway. And protect your money, protect your capital.
I started trading at Goldman Sachs 16 years ago. I was at Goldman for 5 years. I was an equities trader at Goldman. Half That time was spent on the institutional desk trading Australian equities, and the other half was at GSAM, which is the asset management division of Goldman.
How's it going, Tristan?
Tom, good. Good day.
You just presented on technicals.
Technical analysis, that's right. Yeah, I thought it'd be good for the guys to hear a bit about technicals, given my background as a child market technician. I know that technicals is an area that's very poorly understood by retail and also by institutional traders. So yeah, just wanted to run through the basics, talk about supply and demand, give them some things to think about, and hopefully at least get them on the right track when they are using technicals. Yeah, it's not a major part of the process, but it's an important part of the process. You shouldn't use technicals in isolation of fundamentals, and it should be a smaller part of the overall process, but they're key for the timing of entries and exits, and also for filtering trade ideas. And when you're using shorter time horizons with trading, as opposed to longer term investing, the entries and the exits can be a big part of the P&L. So I think it makes sense to spend time studying technicals and getting to know them as best you can.
And so this idea of a process, I was speaking to Anton yesterday about how retail traders can and should approach finding a process when coming into the market for the first time. And he suggested speaking to you about this idea of matching your personality
The process? Yeah.
Why is it so important?
Well, in my view, and this is just my opinion, but in my view, it's the most important part of trading is getting a match between your personality type and your process. And the reason I think it's so important is because when you're losing money, which you will always be losing money at some point, if you don't really understand and believe in your process, whatever that process might be, you'll lack the conviction in those ideas to stick with them, and you'll be shaken out of trades very quickly, very easily. So being a good trader is being good at losing money, and you can't be good at minimising downside unless you really believe in what you're doing. And if you're being forced to adopt a process that doesn't really suit your personality type, or it's a process you don't really believe in, i.e. somebody else's process, then it's much harder to actually have the conviction to execute that strategy properly.
And how can retail traders who perhaps have lots of different options and have lots of different paths they can take in their personal trading career, how can they apply this idea?
Well, I think at the end of the day, you should take a strategy that's been tried and tested that appeals to you and adopt 80% of it, and then try and make 20% of it your own. So I'm not suggesting you're making up a whole thing on your own from scratch, but when you do think you've found a strategy that resonates with you and that you think kind of suits the way you want to do things, be flexible and open when you apply that strategy to bringing your own process into it, your own personality into it. And it's just a matter of trial and error. You spend time reflecting on yourself as a person, thinking about the kind of person you are and the kind of risks you like to take, the sort of things that resonate with you in terms of personal philosophy. And then as you are studying the process that you've chosen, always go back to thinking, which parts of this do I really enjoy, which parts don't I enjoy, what parts suit my strengths and my weaknesses, and try and shape it from there.
So 20% in total, and you can see what that does to the overall beta of the portfolio. Yeah, what we're talking about was the adding a bit of a slightly different risk-reward profile to the portfolio via adding small and mid-cap stocks.
And is it typical that you experience retail traders don't treat different cap stocks differently?
Correct, yeah, they basically treat everything the same. Well, as with anything, obviously it's pretty foolhardy to start trying to trade and invest in things that you don't have any understanding of, but it's even worse when you're looking at the small and mid-cap end of the market, because you've got other considerations which can make the experience that much more painful if you don't know what you're doing.
Well, it's interesting because I spoke to Anton the other day about the importance of building a foundation, the importance of being versatile when starting out as a retail trader. He said to talk to you because you are one of our longest serving mentors, if not the longest serving, and have probably mentored the most retail traders. how important is it for them to start out to build a base level of knowledge?
So over the last 3.5, 4 years, I've actually lost count of the number of students I've mentored, so it obviously is a fairly significant number. And I think apart from the fact that it's gratifying to take people from a situation where a lot of them, to be honest, are slightly clueless, and into a situation where you would actually in some cases trust them with your own money, it's also scary, is the other side of the coin, to think about the situation of the massive majority of retail traders out there that don't have any kind of education or training at all. And so by definition, they're literally trading in the dark. They actually don't really understand what they're doing. And that's why the results are as predictable as they are. I just think it's extremely commonsensical and logical if you think about it. Why would you embark upon anything, especially something as dangerous as trading your own money, if you don't have the right foundations in place? And just really unequivocally and very frankly, you cannot trade financial markets if you don't have the right education. So you need to have a foundation in terms of not just understanding how to buy and sell stocks, but you need to understand how businesses and companies work and really think about how the stock market looks at things, which is always from a perspective of looking forwards as well. So if you embark on that situation and you haven't had any training at all, you are just unfortunately going to end up in the rather sad statistic of the 90-90-90 club, whereby unfortunately the majority of them just have no idea why they're trading what they're trading. So without any foundations or fundamentals, it's just almost nonsensical to even start trying to trade your own money. Once you've got the fundamentals, it's then a situation where you need to be able to put those principles into practice and be taken on the journey from understanding how stock markets and businesses work, and then actually putting that money to work in a sensible, practical way, which is going to enable you to generate consistent returns with at the same time taking the right amount of risk, and be able to apply it not just to one asset class as well, but across multiple asset classes and in multiple situations, which is the other important thing about financial markets that you need to understand, is you need to be flexible and, should we say, supple, and have the ability to apply what you've learned in multiple situations across multiple asset classes. And that's what our video courses enable people to do, which is fantastic, because you're literally saving people from destroying their own capital. And then what we do with the mentoring is we just build on those foundations, and we make you into the finished article.
Get yourself strong watch lists, and these ideas should not drive more than 20% of your portfolio. And if they start working, get bigger, because when the pain unfolds, it really unfolds and goes much further than you think. And one last thing, don't fuck it up. Thank you, guys. Trading life is very different. Trading is actually a very simple lifestyle. You have to cut all the crap out of your life, because really your personal life has to be empty. So you can actually make very well-informed decisions over and over again, multiple times. If you think about it like this, if your personal life is really hectic or your business life is really hectic all the time, it's going to affect your trading decisions. And vice versa, actually. If you have an extremely complicated, very hectic trading lifestyle, then it's going to affect your personal life. So your personal life, your trading life need to mirror each other. And decision fatigue is a big thing in the industry that you need to avoid, because it creates scenarios where you can make bad decisions and it can cost a lot of money. So every professional trader knows that you have to absolutely have a personal life that's simple, and a trading life that mirrors your personal life and vice versa. And you look at all these guys, the mentors, in real life, they've got very simple lives. Guys like Raj, for example, how does a guy become the head of options trading at Bank of America by the time he's 30? Sure. Well, he doesn't get to that stage at such a young age because he has a very hectic lifestyle. He gets to that position at such a young age because he's got incredible focus and he's organized and he concentrates on making sure that his life is extremely simple and manageable so he can make good decisions. Kind of outlook of organizing your personal life and your trading life and creating a scenario where things are quite simple, okay? Think about it like this. When you put a trade on, you're looking at the trade in a way of, does it add any value? Is it going to make me money? Is it high probability to make me money? And it's the same in your personal life. Personal relationships, for example. Like if you go on a date with a girl twice, do you see yourself being with this girl long term? Is she adding value to you? Is she adding value to your life? If you meet new friends, are they adding any value to your life? Do family members add value to your life, or are they a liability on your life? Making sure that your personal life reflects your trading life and vice versa is extremely important, because if someone's not adding value to your life in any way and they become a liability, you have to cut them, because that's going to actually affect your trading decisions, and you could end up with decision fatigue and make bad decisions in your trading life because your personal life is not organized. Just look at it like this. People who screw their personal lives up, screw their trading lives up, and vice versa. People who screw their trading lives up always screw their personal lives up. They have to run in parallel with each other, and you have to manage them to be really focused and really straightforward and simple. Does it add value, or does it take away value? And if you manage that well, you'll be a great trader.
Sometimes you have to give up some social events, or sometimes relationships weren't so easy because you're giving time to your job and you're treating that as a relationship. The key is you need to have balance. You can't spend 24/7 into your job. You need to have friendships, you need to have relationships, but there needs to be understanding that there are boundaries. There has to be an understanding that your job is important to you, but so are your personal relationships. So separating the time, the key is, if you're going to spend time working, spend time working. If you're spending time in your relationship, spending time in the relationship. If you're if you're spending time with your partner and you're doing work at the same time, that doesn't really work for either one, because you're not doing your job well and you're not handling your relationship well. The guys that handle their personal lives with less chaos handle trading much better. When chaotic events occur, they handle them rationally and unemotionally.
Important. To become an all-rounded trader is massively important. Get that foundation. It's got to be one of the most important things for you to always fall back on when you struggle in your trading existence throughout your career. Being able to fall back on that foundation. And the only way you can get that is to have a genuine professional trader who's been there, done it for at least a minimum period of a decade. Get that educational foundation, get the mentor. The second thing you have to do is you have to have a real network. And what I mean by that is guys who have been taught properly, that you can always call on when you have issues, when you have problems, and also to call your mentor. So they're the two most important things. Research your traders and mentors' backgrounds. See if they've ever been a professional trader. Get guys that have done minimum 10 years in the industry and who have made a lot of money from trading as a professional and have been there and done it, and get the network. And this is exactly what the Institute gives you. Get those two things and you'll never ever look back. It's the most important two things you'll ever do. Really enjoyed it. Sad to leave London, sad to leave Europe, but we'll be back and we'll continue to push retail traders to where they have to be, in the right direction. Fantastic 2 weeks. See you next time.